So size does matter, and I'm not a financial advisor. Trading is risky, and I recommend for you to do your own research and understand the risk of trading before you enter into any trade. Welcome to Trading Without Fear. In this episode, I'm going to go over newbie mistake number one, which is adding too much size. We all want more. We want more money, we want more free time, and we want more time with our families. And the stock market can give us an opportunity to enrich ourselves, and we do see people on social media and other platforms stating of how much money and income they're actually generating from the markets. And there are people who make a very consistent income from stock trading, both day trading and swing trading. We all think that we need to have more money and use larger size to make more money and take more money out of the markets. So I was guilty of this myself, especially early on in my trading career, of where as my account was starting to grow, I'd slowly start to increase my size ever so slightly and just continuously do it over and over and over again. By the time I knew it, I was in a trade that I had way too much size on, and physically I could not click on the sell button to cut the trade to take the loss where I should have. And I watched that loss turn into a much bigger loss. Sometimes I would even start to rationalize why I'm still holding on to the trade, start to see things in the chart that I would create in my own mind, thinking, this is just a higher low, it's just a pullback, it's okay, it's going to come back. And what's ended up happening is I'm not able to see the steady downtrend in the chart, and one of the reasons why that happens is it's our mind's way of actually rationalizing and coping with the emotional pain. And what ends up happening is every time the stock will kind of have downtick, once it actually has a slight uptick, it takes us out of our pain, so we start to focus more on the upticks versus the downticks if we're in that position. And it's the same thing for shorts, it's just the opposite direction of where it's going up instead of down. But what ends up happening is you put too much emphasis on one direction to move, and you're kind of oblivious to what's actually going on in the markets. So in my belief, one of the reasons why a lot of people get into trading, even though they may have intentions to become a full-time trader, is the gambling aspect. As even though they may have the intentions to become full-time, and even when I started trading back in 2017, I tell myself and other people that I want to become a full-time trader, and right now I am a full-time stock trader, but in the past I was doing a lot of education for real estate, I was working full-time, I was writing books, and I wasn't really putting everything I had into actual learning the how to trade consistently. And one of the reasons why I think a lot of people end up turning it into more of a gambling form is because they have a consistent paycheck from their day-to-day job. So the key word is consistency. And if you want to find consistency in the markets, a lot of times, you'll hear a stock mentor or a teacher say, you need to find consistency. And for a lot of people, they don't understand what that means. They don't understand what consistently actually means when it's translated into the real world. So when you have a paycheck coming in, you can rely on that consistent money. And when the stock market is the exact opposite. It's kind of like if you work at a job that's commission-based and your income kind of fluctuates. Sometimes you may have a paycheck, sometimes you haven't. Now, I've done a lot of commission work in my past of doing sales, a lot of door-to-door sales, and there'll be times where I'll make tons of money in a day, and there'll be other times where I don't make a lot of money. So a lot of people who are into sales and have done a lot of commission-based work, they understand the idea of what you need to do to have consistency. If you want to actually have consistency and replace your 9-to-5 job, you have to actually cope with the idea that consistency isn't going in with everything you have and risking every penny that you can in the market. So the key word in that is consistency. If you do want to replace your 9-to-5 job, what you need to do is find consistency within the market. And what that basically means is identifying a level in the chart or a percentage target that you're willing to take a profit on consistently every single time, whether that's 10%, 15%, 30%, or if you're a data trader like me where you use past history of stocks that you're tracking to actually determine what the most probable outcome is. But whatever the case is, what you're doing is you're consistently taking the profits when those targets arise without hesitation or reservation of doubt. A lot of the times when traders are actually trading, they end up getting trapped in the greed scenario, which is more of a gambler's mindset of where if the stock is going on in your favor, and you end up not taking the profit at that predetermined price level and let it consistently go up, you may end up taking a little bit higher price, but more often than not, what ends up happening is you continuously create a story in your mind of it's going to go higher, it's going to go higher, and you let that greed kind of feed you, and it turns into more of a gambling scenario, and then either you take a significantly less of a profit than what you would have originally, or you don't take the profit at all and it turns a winner into a loser. So let's say if you're trading with a $2,000 account and you go into a position with $1,000 to $1,400, what ends up happening is you're using a large portion of your capital, and if that's the only money that you have, or it takes you a long time to actually refund your account, you're not just, sitting on $50,000 that you can trade with, but you're only funding it with a little bit at a time. Oftentimes what it does is it causes fear. One of the biggest fears is fears of losing money. What fear does is it focuses our attention on the object of our fear to cause of everything we're trying to avoid. And that quote's by Mark Douglas. So in the same scenario of the $2,000 account, instead of going in with $1,000 or $1,400 or even $800, if you went in with your trade with either $250 to maybe $500 max position size consistently, that's the key, is making things consistent in your trading. Is you have to find a consistent target that you're actually entering into the trade with, as far as a dollar amount that you're willing to risk every single time. So if you're going into it with a $250 position, that may actually mean nothing to you. Making 20, 30, 40 bucks may be like, well, I can make that at a day job. But what it's actually doing is it completely eliminates the emotional side of trading for you. And if you don't feel any excitement or fear in the markets, that kind of means that you're doing something right. So in order for you to replace your 9-to-5 job, you're first going to have to learn how to develop skills. And those skills come from developing consistency within the market. So learning how to take $50 to $100 a trade out of the market versus trying to take as much as possibly can. That's how you're going to develop more consistency in the market, and that's how you're actually going to develop the ability to replace your day job. So this one right here represents the boom and bust cycle of the typical trader. So what ends up happening is they get into a trade, and this, let's say, is $0. That's what they're starting off their account with. And as they're starting to increase their account, what they're doing is they're also slowly increasing their size. And let's say, as they're starting to increase their size, they're starting to feel better and more confident about their trading abilities and what they're capable of doing, come their losses, until at some point they can't do that anymore. Euphoria at some point during this time has actually kicked in and tripped into the state of mind of fearlessness. And I'll go into that in a little bit. And what ends up happening is they have one catastrophic loss that eats away maybe a whole month or maybe a couple of weeks worth of profits. But what they end up doing is they're trying to chase the losses, trying to get back up to what is up here. And as it comes down here, they started to become disciplined and started the whole scenario all over again. As they start to rise their equity curve, they start to slowly increase their size, increase their size, increase their size, until the same thing happens again. And oftentimes what traders may find is that if they get into a certain dollar amount, let's say 4,000, 5,000, 6,000, 10,000, whatever the case is, as they start to approach a certain level in their equity, they may find that as they're approaching that, their self-limiting beliefs kick in and they start to actually eat their money away. That's something that's happened to me in my past as well, is when I started to get into a certain dollar amount, I start to self-sabotage and cause these problems to actually happen. And one of those self-sabotages, without traders realizing it, is slowly increasing your size without you knowing about it, that you're uncomfortable with what's going on because you haven't developed the skills that's required to actually have that size. This is right here is the slowly rising equity curve of a consistent trader. And what they're doing is they're actually taking small profits, either based off of probabilities or based off a consistent history that they know that they like to trade with, maybe 10%, 15%, whatever the consistent dollar amount that, or percentage-wise that they're looking for, that's what they're aiming for. They're not trying to go for anything outside of that range. And oftentimes what they end up doing is scaling into their consistency, and that's what I'm going to actually talk about next. So here's my way of sizing up on your account, especially as a new trader. This is something that I've been sticking with myself. This is also one of the reasons why I ended up creating the $130 challenge on YouTube. You can follow that here. I'll put the link below, and I'll also put another video at the end of this so that way you can check the status of that. Currently, I'm up at 87% overall from the $130 that I started earlier this month. So since you've been watching this video for this long now, I'm assuming that you do like the content. So why don't you go ahead and subscribe. It's right down there. See that? Subscribe. Click on it. I'll wait. You subscribed? Awesome. Go ahead and click on the big thumbs up. Leave a comment if you feel like it. Whatever you want to leave, that's good with me. And we'll go ahead and get back to it. So here's my way of actually sizing up for new traders. One of the reasons why I did a $130 challenge is to show you guys my process of how I'm actually slowly growing a small account and the steps that I'm taking, so that way you can follow the same steps and grow your equity and become a consistently profitable trader. The first thing is you have to be 100% honest with yourself. When you're tracking your data, and I do recommend to track your trades, every single trade. Some people will track their trades in Profitly, and some people will trade it on like TraderView or TraderSync or something like that. It's really hard to actually get the data off of Profitly. I do actually have all my trades tracked on Profitly myself, but when you're actually trying to get the probabilities and you're trying to get actually what you're doing, you probably want to do it with a different platform. Personally, I do prefer an Excel spreadsheet. It doesn't actually take long to actually learn how to do Excel spreadsheets. There's Udemy, there's YouTube videos. YouTube is a great resource to learn how to do stuff for free. All it takes is a little bit of time and trying to figure out what you want to learn and just searching keywords in YouTube. Other people like TraderView and TraderSync, I've never used them, so I can't vouch for those type of softwares. But some people that use them, they say they're pretty great. So the first thing is you have to track your trades and be 100% honest with yourself. How are you doing? How do you feel like you're doing? And you can't BS yourself. Like that's the key. So what you first want to do is, if you do have that boom and bust cycle like I showed you on the chart, what you want to do is completely reduce your size to the point of where it's 100% meaningless. If you have a $2,000 position, $3,000 position, $600 position, whatever the case is, even a 10, 20, 30, 40, 50, 60, $100,000 position, you want to reduce the size down to the point where it becomes 100% meaningless to you. Whether that's buying one share of a stock or 2 shares of a stock, it doesn't matter. So if you're using the example of a $2,000 account, it doesn't matter if you have a $2,000 account or a $100,000 account. If you're trying to find consistency, you need to reduce the size down to where it becomes absolutely meaningless. If you have a $200 position on and you're only looking at maybe taking $20 on a day, it may not look like it's a lot to you. It may not be like, oh my gosh, I only made $20. But if you look at the percent-wise, that's a that's a 20% gain. And there's no bank out there that's going to give you a 20% interest. There's no anything as far as investment-wise that's going to give you a 20% return on your investment in a matter of moments or even a day. So if you're thinking about it in that context, you're actually doing really well. And what you're developing is skills so that later on, when you do increase your size, you're going to be able to use the same skills that you're using to make $20 on to make $10,000, $100,000, $200,000 on in a single trade. Now, once you've actually reduced your size down to the point where it becomes absolutely meaningless, what you want to do is have a time frame, usually about a month's duration, of where you're tracking and you've had absolutely 0 trading errors during that time. And what I mean by 0 trading errors is, if you use a physical stop like I do in the market, you're not going to pull your stop before the market comes out. That also means that you're not going to get out of the trade before you get stopped out of the trade. If the market hasn't come down to your designated area where you think you're going to get stopped out at, you shouldn't cut the trade. The probabilities are still on your side. The other thing is if the market is going up and you're thinking, before you get into the trade, you want to take 10, 15, 20, 30%. Whatever the data shows, whatever you're comfortable with taking, whatever you have already predetermined that you want out of the market, if it hasn't reached that target price to sell, you shouldn't sell that. What you should be doing is staying consistent of where you want to take a profit and you want to cut your losses. And another thing is a lot of traders, especially new traders, and I was guilty of this myself, what they try to do is they try to keep their profit targets and their loss targets or percentage-wise too close together. And that's another trading tip that I have, is if you're aiming for, let's say, 10% profit and your max loss is 10%, and you're willing to allow it to eat down all the way down to that max loss of 10%, what ends up happening is over a series of trades, you end up becoming slightly above, slightly below, or break even. And a lot of traders, especially there's some traders that I've talked to that only have a 5% target, where they average of taking 5% of the market and their average loss is 5%. They have some months where they're green, some months where they're red, some months where they're green, some months where they're red, but over a series of time, very inconsistent for them. It's very frustrating. So what I recommend to do on that side is, if you're going to be doing that, you want to make sure that you're entering into the trade and using the chart as a guide of where you're going to be cutting your risk at, and not a specific percentage amount. The way that I trade, I do have a 3% and 5%, but I do actually adjust that based off where the chart's at. I just kind of make it wider, and on average, based off the data, I'm usually looking at between a 3 to 10% risk, and I can just move those bracket orders wherever I want them to go. But that's another thing, is you want to stay consistent of where you're actually cutting your losses as well. So once you've actually accomplished the 30 days of no trading errors, the next step is actually learning how to maximize the probabilities of your edge. Now what I mean by that is if you have a pattern and you're seeing that you're selling way too soon, you don't need to increase the size. What you need to learn how to do is be comfortable holding on longer. Oftentimes with a lot of newer traders, and sometimes even more advanced traders, is they end up cutting themselves short. And you've probably heard the whole saying of cut your losers quickly and let your profits run. Now what it comes down to is you don't want to let your profits run uncontrollably. You want to make sure that you're hitting a specific target price, a predetermined target price that you're willing to sell at. And the best way to do that is to actually look through your past data and actually collect the data from each individual chart and say, this right here is where it has a higher chance of running, and what's the most probabilistic outcome within that range. So what you want to be doing is, if there's a chart that's running 100, 200, 300%, you're going to get the average of that, and over time you'll actually see that, you may be able to take 15 to 20% of the market more consistently, when right now you may only be taking 5 to 7%. And that's what I mean by finding ways to maximize your edge. That could also be ways to actually scale out of the trade, to make sure that as a trade's working in your favor, especially if you're aiming for a larger profit target, what you're doing is you're scaling out of the trade maybe in 2 to 3 increments to make sure that you're consistently taking money out of the market to make you a winner more often than a loser. And there are ways to do that, especially with a very small account. I do scale out, which is one of the reasons why, if you're interested in learning how to scale out with a small account, do watch the $130 challenge recap videos. I do show every single trade in that, and it'll probably teach you a lot of how I actually trade with the patterns and how to scale with a small account. After you've been actually trading and learning how to maximize your probabilities of your edge and actually maximizing your edge over time, what you want to do is give it a consistent 90 days. Now, one of the reasons why you want to do it for 90 days is it's going to help you actually be comfortable in the style of trading. It's also going to help you be comfortable in developing those skills, because you will make mistakes. And by making those mistakes, if you're tracking your trades, if you're actually having a trading workbook and you're keeping track of your emotional state of mind, and you're actually doing the work to become consistent, you will actually see patterns in your own behavior. And over those 90 days, you can actually develop skills and abilities to correct that behavior. Now, if you can trade like that for 90 days, and you haven't had any trading errors, and you haven't had any discipline problems, and you can actually feel confident in the way that you trade, and you can trade without hesitation and cut your losses without reservation, and you're okay doing that, after the 90 days, what you're going to be looking to do is increase your size. Give me an example. If you're in a $250 position, what you're going to be doing the next time is increasing by $50 to $300. Now, 20% with much larger dollar amounts may not be applicable. My thing, when I was increasing my size a little bit bigger, if I was in $1,000, I may increase it by $100, maybe $200 at most. But for every increment that you're increasing it, it does actually affect how your mental state of mind works. And even if you've had a consistency over a short period of time, eventually that size gets too large for how you feel about yourself and your emotional state. It will cause you to actually have those trading errors, and it will actually cause a drawdown in your equity. So slowly increase the size you're taking, and don't dramatically increase it all at once. So be smart of how you're increasing it, and don't try to think in the same way that you were thinking before of, I need to make more money. Think about it the way as, I'm developing skills to make me more money in the future. If you think about going to college, people don't anticipate going to college for 4 to 6 years or even 10 years to become a doctor, because they think that they're going to learn these skills right away. What they do is they go into the idea of going to college to learn the skills and abilities over time, and so that when they get into the work field, they'll have some experience and some knowledge, but they still have to have the hands-on experience. And stock trading is no different. The only difference is it's more on-the-job training, of where you're stock trading, you're developing skills, but you still haven't developed those skills while you're trying to make an income. And I do recommend to not actually quit your job before you've had at least a while of trading and some other form of income to compensate for the time that you're not going to be working. If you're just quitting your job after 6 months or a year of trading and you're like, hey, I'm going to be a full-time stock trader, good luck, because it's probably going to take a lot longer than 6 months to a year. It's probably going to take on average between 4 years plus. But doing this, slowly increasing your size, the moment you have a catastrophic drawdown, and what I'm considering a catastrophic drawdown is if your risk on average is 5%, and the stock market's coming down and it's getting close to your mental stop or your hard stop in the market, and you decide to take that out and you decide to not cut this trade when you're supposed to, and you let it keep going down and keep going down and keep going down, and trips you into the state of mind that you were in previously, that's a catastrophic loss. So if that happens and you take your trade and you cut it at some point, the next time you get into a trade, you want to reduce your position size down to the next leg down. If it happens again because you're trying to chase the losses, you're going to reduce it to the next leg down. And you keep reducing it down until, again, it becomes absolutely meaningless to you. The whole point here is to take the entire emotions away from the market, and sometimes by not caring about how much money you're putting in there, it does actually affect how you view the trade and how you view the dollar amount. Now, if you're making $100 but you're used to making $1,000, making $100 doesn't matter. What you want is that $1,000. And so by taking away that emotions of I have to make that $1,000, you're only capable of making $100. That's how you take the emotion side of trading. A lot of new traders, when they start to trade and they hear mentors and teachers say, you want to not be emotional, don't want to worry about the money, what they're actually saying is you want to trade with a size that is absolutely meaningless. It doesn't matter about how much profit you're making, and that's what it comes down to. I mentioned euphoria earlier, and I mentioned that's one of the biggest reasons why newer traders end up trying to size up too far too fast, and it causes them to have those severe equity curve drawdowns, and also starts the cycle of boom and bust, of where you're continuously trying to fight your P&L, you're consistently trying to fight your equity over a longer period of time, and it seems like it's almost impossible to go over that. And one of the reasons behind that is sense of urgency. Like I was mentioning before, if you look back at, depends on how long you've been trading for, there may be a specific dollar amount that every time you start to approach or get near or even get over, what ends up happening is you end up getting slapped back down. And one of those things is feeling of confidence and achievement. So take in consideration like a UFC fighter, and let's say Ronda Rousey, for instance. That's a great example. And Ronda Rousey has had series of wins over several female other fighters. She was going into there very confident, and she thinks that she's untouchable. She has a lot of skills. She's actually changed a lot of the female fighting industry for a long period of time. And some of the fights that she was finishing was under 40 or 50 seconds. I think one of the fights I saw was like 28 seconds or something like that. But she was finishing her fights really quickly. And most of her opponents would come in, rush her, and she ended up getting an arm bar and tapping him out. And then she met Holly Holmes. And Holly Holmes ended up being a little bit more patient, a little bit more methodical, taking her time, picking her shots, and making sure that she was more tactical of how she approached Ronda Rousey compared to Ronda Rousey's previous opponents. And it's kind of the same thing when it comes down to stocks and a lot of other things that you do in your life. Is you want to come down to a more of a methodical type of mindset, more of a tactical mindset. And when it comes down to stock trading, it also has a lot to do with probabilities. So the slowly rising equity curve, when it starts to get to a specific dollar amount on the chart of where you may say, hey, once I get close to a $10,000 or maybe even over the PDT rule, I end up getting really, really close to that level. And the moment I get over it, the moment I get really close to it, I have a massive drawdown on equity. So euphoria is a riskless state of mind. And the riskless state of mind prevents you from seeing any sort of risk in the market. In essence, you're oblivious to what could potentially go wrong. So every time you're slapping on more size onto the trade, and the trades are slowly working out in your favor, what ends up happening is you're not recognizing oftentimes of this trade has the chance of failure. This trade could not work. And especially if you're trading the same patterns and the same setups, because there is a probabilities and you don't know what the outcome of each trade is going to be. And you also don't know what the series of wins versus losses are. Like if you have 10 trades in a row and you don't recognize that there's a probabilities within the market, that you don't know what the series of wins versus losses are going to be. And if you take in consideration of 10 trades, and you have every single time you start to increase your size, and you have, trade 1 through 2, you have discipline, you have good position size, and you don't increase the position size, and then 3 and 4 starts to come around, and you start to go, well, this is really working out, I'm going to add on a little bit more size, and add on more size. And by the time the 7th trade comes around, and you're profitable on that 7th trade, you're like, hey, I actually know what I'm doing. I feel very confident in what I'm doing. And so on the 8th trade, what ends up happening is you may end up going with double the position size, or triple the position size that you normally would be comfortable with. And at that time, all it takes is a little fraction of the move to come down against you before it puts you into a state of mind freeze. And because the mind freeze, what ends up happening in your state of mind is you're capable of seeing what's going on, but you're confused of why it's happening. Now, this has happened to myself. I'm pretty sure it's happened to a lot of the viewers out there, of where you're in a trade, you think this is going to work out, you're convinced yourself that there's no risk in this trade, you may not even put a stop in the market, or you may not have even determined where you're going to stop out of the market. And even if you did, all it takes is 1 or 2 ticks down against your position, you already have too much size, and you're saying, hey, I'm willing to take this loss, but you're not willing to take it now because it's too big. It may have been a $200 loss or $300 loss, and you're only willing to maybe lose $50. And so what ends up happening is you freeze and you watch that stock slowly tick away on your account until the point of where the pain that you're feeling emotionally is 1 degree greater than the dollar amount that you lose. And so you end up snapping out of it and you cut your loss, and you end up being mentally distraught by what happened. You end up almost in a depressed state of mind, almost beating yourself up. And at the end, when you look at the chart and you're no longer in it, you can clearly see what's going on. So fear focuses our attention onto the object of our fear until we cause the very thing we're trying to avoid. After you take that first big loss, what ends up happening is you try to chase that loss. So the next time another opportunity comes around, you end up going in with the same size or even more size. You also don't know what this series versus wins versus losses are going to be based off the pattern of your edge. So what ends up happening is you end up taking another loss for the same purpose again. So stick around, follow my journey through the $130 challenge. That way you can learn how to grow a small account consistently and safely over time. And we'll see you next time.